We're good now.
All right, calling the Olivet Pension Board meeting to order. Oop. All right, let's start with the minutes. Do I need to, do
I'll
people
do a
need
roll
to?
call. We'll have
Roll call, go ahead.
Mike Frenberg
Here.
here.
Present.
Let's see. Ted Isaacs,
Here.
Jennifer Yackley,
Here.
Alan Robbins.
Here.
Good. And then we have Commissioners Hadley, Burke Bugler, and Isenway are absent. So item 1.
I don't want approving the minutes. Do I have a motion to approve the minutes?
Motion to approve the minutes.
Is there a second? You can vote.
Alan, I think that has to be.
Oh, Alan, you might. Can you
Second,
vote?
second,
Oh, you're-
second.
Okay, Alan Robbins second.
Okay, is there any discussion? All right, all those in favor? Aye. Any opposed? Awesome. Okay. I think you guys are up, right?
That's right.
Tom and Jonathan, go for it.
All right, so we have the first quarter report. We can speak through some of the fun of April, but we survived, right?
There you go.
Yeah.
That's good.
Is that good?
Yeah, especially since all of us are investment people, so.
Yeah, you know. It's,
Although it was good information, I thought some of the statistics were interesting.
yeah, definitely.
So
Obviously,
it was good.
a wild ride,
I
but
recommend anybody read it.
more to come
on that.
probably, right?
Yeah. Oh, yeah.
So some of the additional business that we'll have, and I'll let Jonathan go through the report is, remember last time you authorized us to do a high yield search.
Mhm.
So that is in there. Jonathan will say a little more on this, but coincidentally, perhaps not long after, it was coincidentally, after we talked to you guys about doing a search, Principal informed us that they actually swapped out the high yield product that you had access to another one. And the other one was the one we actually used with other clients. The one that you were using, the only one you could use,
Right.
put it that way,
Mhm.
was one that we went through, no one was using. So that one actually was shutting down because no assets were in there, assets were decreasing. So we'll still do a search, but what was more of a kind of a code red, it's not as bad, but we still think makes sense to talk through that. We have some options that we like.
So is the replacement a principal product still, or is it?
Yes. Well,
But
no,
it's the one that you
so the principal switched into another principal product, and the search we have is non-principal products.
Got it.
And
But you're saying the one they're switching to is one that you do use with?
yes,
other
with
clients.
principal.
Okay.
Yeah.
Got it.
So the other options in there, and as a reminder, from like a sizing standpoint with your cushion and all that, we talked about maybe kind of a half measure, maybe take $500,000 out now, and as things kind of continue, eventually taking more out. So we'll talk through that.
Mhm.
And then last but not least, with some of the changes that have been made, propose some changes to the investment guidelines. So that's on the menu. We'll keep you moving.
Perfect.
All right.
Yeah,
Thanks,
excellent.
Tom. Darren's already on the page that I was going to instruct you all to get to, but page 4 in the report, exhibit 1. So this is your market value page. Shows all the market values beginning of the quarter, so January 1st through March 31st. So you see at the total fund level, the fund started out the quarter with just over $23 million. You had net cash flow out of $555,000, just a little over that. And ended the quarter with $22,377,508. And as you go up and down pages 4 and 5, you see the percent of portfolio, and then to the right of that, policy percent. So policy percent is the target weighting that you want to try to maintain for all your investments and your composites. As you go up and down the pages, you see pretty close in most cases at the composite level, little underweight U.S. equities, little overweight cash. And I'll get to why cash is a little heavy here in just a moment. 2 things I want to point out. The first thing Tom already briefly discussed, you see there's 2 principal high yields on page 4. So one is the one that we lost access to, and they actually shut it down and merged it into the new principal high yield fund that you are now in. And that occurred on February 28th. So we kind of had to flip the old one out and put the new one in. More on that here in a bit when we get to performance. And then on page 5, you see the on the top of page 5, principal U.S. property. We did have a pretty sizable redemption request in for that investment, and you see that through the quarter, just over $573,000 came out of that investment. So now we're actually at target for real estate. The target that was just set at the last meeting of 5%.
Great.
So yeah, thankfully the floodgates kind of finally opened, and they paid out. They actually fully paid down their redemption queue. Principal did, so good to see that.
That was inclusive of the one that we increased last time
Mhm.
to
Yep.
come down to target. And
Yep,
it was
everything's
accepted
out.
right away.
Yeah,
great.
they just said let's get it done.
Sweet.
Good. Good.
Yes, thankfully, real estate may have, it looks like it's kind of bottomed, so
Mhm.
they're trying to get those redemption queues wound down and start getting people to contribute again. Flip ahead a few pages to page 12. I just flipped ahead because a lot of the performance information is repeated.
Mhm.
So on the top of page 12, you're having total fund composite. You see for the quarter, it was just down 0.4% versus 0.5% at the level of the benchmark. So just ahead slightly. As you go across the page for longer dated timeframes, you see it's kind of a mixed bag. You see for 1 year, you were a bit behind. Same story for 3 years and 7 years. 5 years, you're a bit ahead. And then since inception, you are behind. And rankings wise, so comparing the plan to other public defined benefit plans, you see the rankings are kind of mixed, typically in the middle to low levels, 100 being the lowest, 1 being the highest that you could be in the universe. Next, you have your fixed income composite, and unfortunately, that was a rough spot for the quarter. You see it was up only 1.9% versus 2.8% for the benchmark, the Bloomberg Aggregate Index. The underlying, or well, sorry, for the long term though, the fixed income composite has done pretty well, typically ahead of the benchmark, slightly behind for 1 year and since inception. And then looking under the hood, you see principal core fixed income. That's done pretty well. It's typically been ahead or just behind its benchmark across all time frames. Rankings typically mid to low. Then you have principal core plus bond. Long term, that's done well, but ranked low. And more recently, it's struggled a bit over the quarter to 3 year time frame across the page. There, it has underperformed. Next, you have that new principal high yield account. We do still have the other principal high yield account that ceased to exist. That's baked into the composite level data and the total fund data. But since we didn't have any information for that going into the end of the quarter, it wouldn't populate a return. So this is your new one. But just for the sake of continuity, I wanted to see for the quarter if you combined your returns for the prior one that discontinued and the new one for the quarter for that 3-month time frame, it returned about 0.4% between the two, so behind the benchmark. And then lastly, for fixed income, you have Aristotle Pacific. That's your bank loan manager, and they were doing pretty well. More recently, they are starting to struggle, underperforming for the quarter and for the year, and just in line with the benchmark going back to since inception when you first hired them on in September of 2022, but ranked high since inception in the top 20% of their universe. But overall, for the quarter, your core and core plus held up fairly well, but we kind of got drugged down a bit by those more higher octane fixed income components with your high yield and floating rate bank loans. Next, on page 13, I'll be very brief on this one. Your U.S. equity composite was actually a bright spot. It was ahead of the benchmark for the quarter, only down 4.4 versus 4.7 for the benchmark. Longer term, lagging because we did have that tilt toward a higher tilt towards small cap and mid cap stocks. That was since reduced more recently to bring it more in line with the weightings of the Russell 3000. But the underlying, your Vanguard S&P 500 index fund, Vanguard mid cap index fund, and the iShares S&P small cap fund, those are all in line with their benchmarks that they're trying to track. Page 14, at the very top, you have your non-US equity composite. That was behind for the quarter, kind of mixed long term. You see it as ahead for 1 year and 5 years, but otherwise it has typically lagged. And then looking under the hood, the total international stock index, the all world ex-US small cap index, and the emerging markets index actually doing well recently, typically outperforming the indexes they're trying to track, but long term they have lagged. Typically, you will see that tracking error with international index funds, just much harder to replicate than U.S. equity index funds.
Can I,
Next.
can I ask on
Mhm.
the 3-month numbers there? It says it's up 4% for the quarter. Am I
Mhm.
reading that right? But
Yep.
every fund below is beating the benchmark. Like how does that tie into the total international return when?
So from an additive perspective, it depends on the weightings. So I believe you're more equally weighted across all of them. So the total international fund is more developed stocks, and that's really where much of the higher returns you saw in international equities was more from developed markets. But your small cap exposure and emerging market exposure was behind that.
So you have 18% allocated to non-US. 11 of that is that Vanguard Total International stock. So that's 5.5%. So that's definitely be pulling harder.
Mhm.
I'd like to see the other two
Drug it down.
3.5% each. So it's just a weighting.
Okay.
Yeah. Unfortunate those others drug it down, but that's the way it is. Then you have your real estate composite, just one account in there, the principal U.S. property account. And that matches along all the way. You see it struggled in the last 3 years. It has underperformed for all those timeframes, 1 month through 3 years. But long term, it's either at least matched the index or outperformed. Then you have your private equity composite, and that's just a Partners Group, the open-ended private equity fund. And you see that has outperformed as well long term. We didn't have the benchmark yet for the first quarter. It takes a while for them to calculate those, typically about 3-month lag. But long term, it has outperformed. And then cash. We don't keep a lot in cash, but it's been a good place to keep money the last few years. Thankfully, that short term rates have been up in the over the last few years. Otherwise, they've been pretty minuscule, as you all know. And then I'll finish the annualized performance. The next few pages are individual calendar years, but I'll skip those. And we'll go ahead and skip to the fee page, which is page 21. All right, Darren's got it. So what this page shows is we take the market values as of the end of the quarter, estimate what the fees would be based on those values. And you see what the estimated annual fee is for each investment on the right-hand side there, what that equates to in terms of an expense ratio. And then it compares it to the industry median for similar type investments and strategies. And then there's a blue row, second blue row from the bottom of the page. We aggregate all those fees together, calculate an expense ratio, and then compare it to the industry median. So we're estimating as of the end of March, you're paying about $85,973 annually to all these investment managers. That equates to an expense ratio of 38 basis points. And that is just slightly higher than what the industry median would be of 35 basis points. So 3 basis points above the industry median. And then below that, we have our fee and then the custodial fee for regions and total that up down there as well. And that'll conclude the first quarter report. Any questions? All right, I'll skip through the rest of this because it's benchmark history and characteristics pages for the underlying investments. So we'll go ahead and skip to, I believe there's a handout at the very back of the quarterly report. So if it had page numbers, it'd be page 39 and 40.
Of exhibit
This is
3
the trade recommendations?
Yep,
that one?
right there. Yep.
of this? Okay.
Mhm. Sorry, just the timing of the meeting. We couldn't generate it till this morning. So we'll go with the rebalance page here. So you see all the investments as of April 30th, and then totaled up at the composite level, and then as well at the very bottom there, just for the total fund. Pretty much in line target or weighting wise, again under for U.S. equities, over on cash as we saw at the March quarterly report. We estimated the total plan had a valuation as of the end of April of $22,254,780. Just for fun, I did estimate your return for April. It probably won't be exactly this, but only down 0.55%. So not bad. If you hibernated the whole month, it's almost like nothing happened. And then we have recommendations for rebalancing. And I wanted to take a more measured approach with this. I didn't want to bring us all the way back up to our target for U.S. equities, but I wanted to at least bring some in from international equities. So we'll, as of the end of this, once I finish explaining, essentially the U.S. equity composite will still be 2% below its target. Currently, it's 3% below target. But anyways, here are the recommendations. Recommend contributing $140,000 to the Vanguard S&P 500 fund, 80,000 to the iShares S&P Small Cap Fund, taking 170,000 from the Vanguard Total International Fund, 10,000 from the Vanguard Emerging Markets Fund, 40,000 from the Vanguard International Small Cap Fund. And then when we get to fixed income, recommend replenishing the principal core fixed income account. That's where your benefits are being paid out of. So that gets drawn down over the course of the quarter. Recommending 500,000 be contributed to that. 500,000 be taken from the principal high yield account, and that's going to kind of be in conjunction with what Tom is going to get into here in just a moment with your high yield search. 500,000 go to a new high yield fund yet to be determined, and then take 500,000 from cash, but still keeping a bit of a buffer given the volatility we've seen in the markets recently.
Are these, these are not based on the new percentages?
No, it is.
It is?
Mm-hmm.
Read that one. I must have read
Yeah,
that.
the
Okay.
5% for real estate.
Right. I thought, maybe I read it wrong.
So the large cash position is based on the redemption from principal, the real estate redemption.
Hmm.
So it's reallocating the cash, and then Darren, there's a big payment that comes in June.
Oh, I see.
Yeah,
Okay.
the city will contribute. The rest of the property tax collections, it's about $300,000.
Okay. That'll just be an influx into the,
It goes into that core plus, or the core fixed income, the one that's used for the benefit
It'll
payments.
go in there and that'll be part of
Reallocated,
what
whatever.
we-
Yep.
So we'll ask for less in August.
Mm-hmm.
Not that we're asking, we'll recommend.
All right, so this is what you're requesting, correct?
Mhm.
Yes.
Right. I'll make a motion to move forward with the recommendations from Tom and Jonathan, based on the changes they have presented. Do I have a second? Perfect. Okay, discussion? Anything? Mike? Alan, you have any questions? He's driving. I don't want him to have an accident. You're muted, Alan.
Maybe you might be able to unmute him, Darren,
Yeah, I can.
potentially.
No, you can ask.
I asked
I can
him.
ask.
No, that's lame.
What are they talking about?
All right, we'll take that as Alan.
Give me a thumbs up.
Oh, I think he's,
Okay.
Good.
Okay,
I thought
good.
thumbs up.
there we go. There we
All right,
go.
perfect. All right.
The minute show.
Yes, let the minutes show that Alan gives up. All right,
Thumbs up emoji.
all in favor? Any opposed? Any abstentions? All right, we're good.
So obviously you have a little bit extra cash, 100,000
Mm-hmm.
plus the influx from the city. So if we have a fun summer with markets, that's just less that we have to do at the next meeting. So
Yeah.
that seems pretty.
Okay.
All right. Hand it over to Tom.
Oh, he's coming in. Can you lock the door?
Unlock yes.
No, not unlock it, lock it.
Oh, there it is. I see him.
Oh,
Yeah.
good. We can just leave him on,
real time of.
Yeah.
funds.
just leave him out there.
So next order of business
Rule.
is the
Let's get
Yes,
I know.
yes, so do I very well. The last 35 years.
It's like a reality show.
I liked you better on there, then I can mute you.
Hey,
You can turn up.
howdy, Alan.
Very good. Say his name and he
Good, how
can
are you?
appear.
Yeah. All right, you're good. You need to shut that off.
So meta.
Yeah.
Too much.
Go ahead.
Too much. Okay, so next section is the high yield search.
Okay.
And, as I mentioned, not as code red, I guess, as it was previously, but still think it makes sense to have this conversation. If you turn to what is the second page of Exhibit 2. Yeah,
Oh, yes.
so this is who we have in the lineup. So you have we have JP Morgan, Nomura, Nuveen, and Principal, and this is the new to us Principal fund. So there's always just list some high level things there. So down below, JP Morgan, their fundamental bottom up. They tend to have lower turnover. They focus, their focus is really on their quality of security selection. Nomura also fundamental, bottom up. Their focus more is on kind of a low tracking area. You'll see they have a lot more securities in their portfolio. And then you have Nuveen. They're more of a combined approach, a little bit of quantitative thrown in there. You see it says loan bias. So some of these high yield funds tend to sneak in bank loans in there, and that can be fine. You just need to be mindful of that. We already do have bank loans, obviously, so obviously we'll talk through that. And then Principal, the new one for us. We kind of view this obviously as all weather. Many of these are all weather. They like to say that their focus is on security selection. So let's jump to maybe page 4. That'll do this. Page 3. They're all pretty close to each other on their estimated sources of value adds. So I won't even worry about that. So this page just gives you a snapshot of kind of the overall high level quality, as well as just some kind of metrics within there. So as I mentioned, Nomura has a greater number of holdings. Not all of those are individual companies, though. They will go up and down the credit stack from from the same companies. So just be mindful of that. You can see spreads on there, time to maturity. Principal is an outlier on them. They're at 7 years right now. Average quality, most are B plus. Average quality, Nuveen is the outlier on that, which is B, likely due to some of their lower grade loans. Next, maybe jump to page 6. This is a good one to kind of look at some main differences here. So we have different categories there overall within these. Syndicated bank loans, you see JP Morgan 7%, Nomura is kind of a rounding error, Nuveen at 16%, and Principal at a rounding error as well. So you already do have bank loans within there with Aristotle Pacific. So if I were to kind of knock someone right now, Nuveen, they do a great job. We have them a lot of clients, but being that you already have that allocation in there, I'd kind of look a little beyond that. And then high yield bonds, most of them are gonna, be heavy on that. Once again, the exception is Nuveen, and that bank loan number will go up and down. That could be low single digits, but they've been flexing into that. And historical performance on page 7. Like I said, this is the new to us Principal fund. If it was not, it'd look a little uglier than it did. So on here, you can see the overall returns, standard deviation on there. Obviously, past performance is not indicative of future results, but we'd like to at least see kind of how they have done through time. You can kind of make some inferences there. Long-term speaking, Nomura, has kind of been the leader overall from a return standpoint. Principal, the new to us Principal fund, certainly holding its own. So the one that we were forced to use would not look as good as this for sure. From a volatility standpoint, just kind of zeroing in on that. Historically, Principal's kind of been on the lower end outside of the year to date so far. But on there, you can kind of see that JP Morgan, from a return standpoint, historically, it's kind of been the weakest of these through most periods beyond
So I'll interrupt you real fast
Please do.
and ask you a quick question.
Yes.
If we pick principal, it helps our index, thank you,
Yeah,
correct?
yes.
Do you feel that any of the three, JP Morgan, Nomura, or Naveen, is much better, that we shouldn't care about the index, that they override, or is principal like it's sort of flipping coins and we should keep it because of the index? I hate to
So-
make decisions that way, but we're in
Well,
that.
yeah, obviously. So your cushion is at like 1.4 or so.
Right.
So you're obviously very comfortable.
I mean, I'm just talking about, this could be 2 years from now, 3 years from now, whatever. It still helps us.
So
Yeah.
our house view currently, so if
Uh-huh.
you think about our top picks in high yield. Nuveen is up there for clients. It's more for clients that maybe not have bank loans. And Nomura are kind of one or two for mutual funds. We have others that have commingled funds and all that, which obviously we're not doing. Just purely from that, if my research people were here, they would say making the switch, at least starting that process, to someone like, in this case, Nomura would be their recommendation, their preference. Fees are a little lower too. And you look, if you also look at the potential, kind of, let's go to. So it's in the glossary. Look at the excess return correlation, just to kind of see how they've interacted historically speaking. And find it soon.
Just want to make sure.
What's that?
No, and the reason, as you're looking for that,
Here we go.
and obviously past performance can't,
Correct.
you know, we know that. So, but 10 years principal is 4.8. Nomura is 5. So we're talking about, you know,
And standard deviation is 6.6 higher.
It is.
it's a little higher, and I get that,
Yeah.
but we're talking about, what, 20 basis points? Am I 20 or two? Yeah. No,
Annualized, yeah.
Yeah.
No, still, obviously, it's.
I mean, again, is it worth that, you know, over the 7-year period,
Mhm.
you're at the same thing, right? The 5-year period,
Mhm.
you're 10 basis points.
Yep.
I'm looking at Nomura. So, and versus principal, in 3 years, you're better. So that's what I mean. I'm not, and you know, I'm not a fan of principal at all, so.
Yeah, I mean,
Yeah.
the punch that this search would have had,
Mhm.
had they not done that, has been softened up clearly.
Yeah.
With switching us to the product that we would have wanted to be in the first place.
Mhm.
So just from a fee standpoint, just so you know, 67 basis points, which is lower than what the principal, bless you, what the previous principal fund was. So 67 basis points, and Nomura in this, for this discussion, is at 54.
But the returns are net of fees.
Returns are net fees.
So it's, you know.
Yeah.
Yeah. And I don't want to pay any extra than we have
Of
to.
course.
So anyway, so that's what I bring back to you guys.
This benefit calculation does not assume we're taking I know in the trade
Correct.
recommendations, it's 500,000 out, but this is still assuming we're keeping it all in.
So
principal.
benefit, I did it on my, without updating it, was 950,000 was the benefit, if you pull out 500,000.
Yeah.
So it's not really
Yeah.
a 1-to-1.
And where do we like to be? Like kind of at a million?
It will change to a degree from a philosophy standpoint. As you've reduced your risk, doesn't necessarily need to be, you know, if it was all in equities, I'd say
Yeah,
sure, 2
yeah.
million, right? So
Right.
1 million, it seems to be historically a comfort level, but you've reduced the amount of just volatility and risk within there. One thing I'll just show you,
Yeah,
page
please.
23.
No, as I said, as you were looking for that, I wanted to ask you that question, and it might be rhetorical today.
It is, like I said, the punch on this has been, that's okay, we still wanted to discuss this. So this, the top table here is the 5-year excess return correlations relative to the high yield index. So if we were to say, okay, you got principal, we know that, you're gonna keep that to some degree, either all of it or some of it. Which ones at least complement it the most from a excess return correlation standpoint? Nomura looks like it would have the relatively speaking best pairing between the group, at least from the past 5 years. So like I said, this is not flashing code red. If it's obviously your decision from a comfort level, you've seen returns, you understand the fees. Another alternative, I guess we could look at potentially down the line is Core Plus. You have Core Plus, obviously that's a bigger beast Core is gonna be here for a long time, but you also have Core Plus, and that's another space where there are a lot of other options out there. We could start denting with that.
If you look at just return correlations over a 10-year period of time, how's it turned out? You have any idea? Because if I look at the 5-year period of time.
Yeah.
That's an aberration in what's gone on in the bond market
Sure.
for a long time.
So
5-year correlation, better than 10-year correlation.
I was part of the process to update the search books.
Okay.
My research people would say 10 years to look at that is too much noise at that point.
Too much noise at 10 years.
Yes,
Interesting.
I took your
Alan,
stance on it.
Alan, can you turn your microphone on? There you go.
Hmm.
Now you're.
Well, their duration's at 7.
Yeah.
Well, that's the other ones are at 5.
So,
And the appeal too is we get 500,000 out of principal that could later be rebalanced into something else, right?
If you don't need it, sure.
sure.
Yeah.
But I guess the flip side to that is if you're like, hey, like I said, if this was the old product, we would have a different posture.
Right.
So I guess the issue is if you do start pulling out and say, okay, principal high yield, we're gonna start that process. Then effectively, if you wanted to look at, Core Plus, you can't do that for years. So that was like plan C in my back pocket here was if you weren't interested, because clearly there's not a huge.
So I guess the question is that, is Core Plus underperformed relatively? I mean, are we better off moving Core Plus and leaving because it from, again, past performance, but based on past performance, principal high yield, the one that we're in now, really it's not like, oh my God.
It's no longer that, yeah, your order of, problem children was high yield was
Right.
the problem child, and
Right.
they self-selected out of that. So I guess if you maybe go back, just so you can get Exhibit 1, page 12 is the history of fixed income funds, and obviously the principal high yield is only your experience only.
Can I ask another question?
Yes.
Related to, has there been any change in the makeup of their managers of their core bond portfolio and their high yield bond portfolio? Maybe bring in a different team from a different firm that may have some impact on the way they view things, therefore impacting the returns.
The high yield is a wholly different team. So they swapped it out. These are completely different people. They've been at that product for a long time. On the core side of things, principal tends to, most of them are in Des Moines. It's a pretty stable,
Right.
stable group. So there's not a ton of.
So
return.
if we were going to look at Core Plus,
Yes.
would we go outside principal?
Yes.
Okay, my recommendation would be to look at Core Plus next.
Yeah.
And then come back and make a decision, but stay with high yield where we have it now at principal and come back with Core Plus, because maybe it's a better option to move some of the Core Plus.
Yeah.
Rather than the high yield. Does anybody?
That makes sense.
The Core Plus itself is the problem, or is it? I always, that one, I thought, remember way back with the benchmarking was the problem. Like, what do we benchmark this thing against? Because it's kind of an odd critter itself.
It is.
Okay.
That's what we have it against the mortgage back too, because they are heavy in some mortgage backed securities there,
Mhm.
which, if you want a Core Plus, you want a little more diversification,
Mhm.
especially in the plus side of things. I don't want
Right.
to just be saying, okay, all we do is mortgages. We do a lot of work with, like Commerce,
Mhm.
like Scott Colbert, they'll do a great job on even Core and Core Plus mandates on that. there's a lot more options in that space, and it's the only thing we just want to make sure, obviously, if you were to say, okay, let's getting ahead of ourselves or pull some out of the Core Plus fund. I think there were some time periods where that fund was pulled for benefits. I don't know why or
Yeah,
when.
that one wasn't available for, the principal let us know that one, we couldn't use that one to pull benefits for whatever, I don't know if there was
I remember
time period that they, that they couldn't
they pulled for
liquidate
benefits.
in certain, so that's why we have to use that fixed income.
Yeah, that's,
Or something.
I
that
do
degree.
remember for some reason, they did pull from the Core Plus bond.
Yeah.
at one
So
point.
I guess I should say, I should back up too, because I'm trying to like talk you out of using this one because it's a problem child, but we're looking to get money out of principal and that's one of them that would. That's the next one that we would go to.
Yeah,
Yeah, because if high yield is gonna stay. So
Yeah,
that's,
that's
it's a
what-
different kind of problem, not because it's not meeting benchmarks, but because this is the next one in the list that would exit to go to a different product.
yeah, I mean, I don't know how many, 20 years, whatever that is. Probably, if we had the ability to just say, let's start from scratch with no constraints, you have a principal real estate fund, and that would probably be it.
Yeah. No, we all agree with that.
Yeah,
Okay.
that's a great.
So,
fund. Like
yeah.
I said, obviously, high yield is,
Right,
it's a better option than it was. But.
correct.
so,
Okay.
everything gone.
So let's do that. Why don't you guys come back with some options there and we can look at it
Yeah.
as a whole. And with with everything along with what's it called?
High yield in the core plus.
No, the
Index.
index, thank you. It's a big word for me right now. The index, where we can stay, where we,
Yeah.
we're comfortable with that. Thank you.
Perfect.
It's a big word. So, all right. Let's move, should we move to section 3
Yes.
or exhibit 3?
Yeah. The guidelines.
Just make sure this wouldn't impact anything.
No, yeah, no, nothing with the
Okay.
high yield decision should
Okay.
affect us.
So section exhibit 3, first page 1, the date, it's easy. Page 2, no changes. Page 3 is a reflection of the asset allocation that was chosen. Just some tweaks throughout there, as Jonathan mentioned, kind of pulling in a little bit of that mid and small overweight. You still are a little bit overweight. We're just not kind of really extended there. Real estate down to 5 and private equity up to 7.5.
I thought Mike demanded that we have round numbers on everything, didn't you?
I must have also been napping during that for a bit.
We love the halves, just feels. so
I know, it's like, really?
Changing the world.
I know.
Okay,
In fact, I
so
think that was my
bottom-
motion.
No, it wasn't. Your motion was the 7.5,
Yeah.
not the motion. You wanted the 7.5, which screwed everything else up.
Bottom of the page is, it's just your total benchmark reflecting
Mhm.
those changes. MSCI purchased what was Burgess, what was before that Cambridge, so benchmarks are good business, so everybody's trying to buy it. No changes until page 9, which is the addendum. So this, obviously, the addendum may change if we make any changes to any of the manager lineups. So, but what we have right now is just and I deleted some of these, the blue ones are. We have a habit of putting all these asset classes in, even ones that make no sense for clients, so I just finally said, let's get rid of those. So I did that, and then in yellow, I just didn't know if there was gonna be a change on principle, so we could just say. Make the changes as prescribed. That's it.
Yep.
Changes to the addendum don't require council approval, right there?
Does not.
Is it just it's just the targets
Yeah,
that we,
that's the main document.
All right, so we should
Do that.
motion to approve.
I think a motion to recommend.
A recommend to the
recommend to the
council.
council.
Recommended.
Council.
Mike
Second.
seconds it. Discussion. Anything? All right, all in favor?
Aye.
I'm not gonna ask opposed because we all three voted for it. Does Jennifer vote?
She's there. I
Jennifer,
think
what?
so.
Does she vote?
She is a voting member, yes.
Okay, well, I didn't hear. Is she still on?
Yeah.
Yes, I vote yes.
Okay, that's fine. I just didn't want to exclude you. I, you know,
I don't know.
okay,
I'm good.
okay. That's why, you know, I was conscious that yeah, anyway. I didn't want to exclude you.
Thank you. I appreciate
Yeah.
that.
We got our homework.
Yeah.
Corporate search, we'll bring back the high yield for discussion. And then, one other thing, our symposium's coming back. It's in Chicago. It's also November 26th. It's also virtual. Howard Marks is gonna be our keynote. And then,
Groucho was dead?
what?
I thought Groucho was dead.
He visits with us about once a year, so, he's good, he's good. So we got that. I know we're gonna do like a panel on AI. So everybody that is, every conference you probably go to now has something like that, so we're gonna join on that. Then a variety of other things, private equity, kind of exits and kind of the slowness of exits and how different strategies are kind of working through that. So yeah, a bunch of other stuff, so you can join us in person or virtually.
Full day.
Half day, but come the night before, cause then
Very good. All right. Any questions for these gentlemen?
Nope.
All right, good. Thank you very much.
Thank you.
We
Thank you.
appreciate it.
Okay.
We'll see you in August.
I think just me.
Oh, good.
He's
I may be virtual or not,
Okay.
family trip.
Yeah.
That's
Oh,
yeah, I can handle it.
coming, so. We got.
we'll bring our tough questions.
Yeah.
Yes.
Yeah,
A lot of digging into the core plus.
yeah,
Mhm.
Wild world.
exactly. All right, good.
What's that?
Where you headed?
So we're gonna go to Los Angeles and San Diego.
Hmm.
Nice.
Nice. Very good.
They'd say author on move.
Well, no, I have a question for Jennifer, but does anybody have anything else for new business?
Yes. So I don't know if this is needs to be official note, but I'm moving out of Olivet likely 12 to 18 months from now. So I don't know if we wanted to backfill. I can't be on the pension board, I don't think, if I'm not a resident, right?
That's correct. Unless you work here.
It's not happening. Sorry.
Oh, no way.
So just I'm happy to serve until I move, but just wanted to put that out there.
We'll take a look. Yeah, thanks for letting us know.
Good. Any other new business? Old business? Jennifer, did you
Yes.
ever ask the council if I could talk to an attorney about our contract with Principal?
No, I did not ask them, but I will ask them on Tuesday.
Okay. Okay, good. And it's informal.
Hmm.
You're more than welcome to be there too. I don't know,
Great.
attorney, I was just referred to a few, so I just have names,
Yep.
so.
Perfect. I will, we're in work session, on Tuesday, so I will ask them then.
Okay, perfect.
Okay.
All right, any other old business? Great, motion to adjourn? Meeting adjourned.